Ladies and gentlemen of the crypto space, we're live on a Thursday, July 1st. Whoa, really? It's the flip of the month already? That's awesome. 11:42 a.m. and let's get this party started. The markets are filled with what the one word uncertainty. We have no idea what's going to play out. We have so much ideology, so many brilliant people. You'll go on mainstream media and you'll see people saying inflation, the gold bug's inflation. And sure, with 25% M2 debasement, yeah, you could consider how much they've changed the metrics and how it's calculated. But we know they issued a fair amount of M1, which gets 10 to 1 leverage at the Fed and all that fancy stuff and the primary dealer shell game with reserves. So we know there's been debasement. Whatever the number is, doesn't matter. It's greater than zero. So what is it? We know what the effects of debasement are from brilliant contrarian minds like Stephen Van Meter and the milkshake from Brent Johnson. We know there's a dollar shortage. We know that QE is deflationary. It removes liquidity from the system. We know that the Fed plus the Treasury bypassed commercial banking's money creation process. Money is created by double entry accounting, where there's a loan on the books of the bank and there's a liability on the books of the debtor. But the Fed and the Treasury were able to bypass that, which is illustrated very nicely by George Gammon, as he so eloquently does all the time. So we have all this talk of inflation and all this logic and rationale for why there should be deflation no matter what anyone does. I mean, look at Japan. They've been they have like what is it, 250% debt to GDP, and the central bank owns everything, almost everything, and they've been doing this for 20 years, so they've never had inflation. That's just pure deflation over there. So what does this all mean? That means, I give you very high level answers that it means we know jack shit with regard to how assets and asset prices are going to behave. We got, in my mind, what I like to say is we got inflationary forces and deflationary forces everywhere. And those words semantically are misleading because people say, oh, we have inflation in our system. But that's not the way it works. We have inflation in particular systems. What is inflation? What does the word mean? It means increasing, it's inflating. Think of a balloon. A balloon is either inflating or deflating. But instead of thinking about the entire macro system as either inflating or deflating, it is so much more reasonable to look at very specific things. For instance, if the circulating fiat supply is inflating. And now it's questionable whether that circulating supply is, restricted to the banking sector or it's actually in public circulation. That's a reasonable question. Is the price that I pay for cheese at the grocery store inflating? Yeah, I paid more for cheese. The price has inflated. Has the price for lumber inflated and now is deflating? So basically, inflation and deflation really just mean up and down. Price go up or price go down, supply go up or supply go down. Very misleading. People think it's a magical word. It means some mystical thing. And it's important to understand that it's not a magical word. And it's not as simple as people think. Uh, anyway, that's my intro. That's my monologue intro. Hedging the hedges of the hedges. And that's how we handle these words and these semantics and these topics of conversation and these questions. Let's jump into the stream. Today's episode is sponsored by Changing, the non-custodial swap exchange for social good. Stop depositing on exchanges, not your keys, not your crypto. Non-custodial DeFi or nothing at all. Bang, let's pop it over to the main screen and see who's in the stream. Yes, we got George in the house. Good day, Noah. Got a question already. How do you hedge your wealth against a catastrophic recession? By keeping what you have inside the crypto space. The odds are the vast majority of the crypto space will not be deflation protective. Deflationary events tend to be destructive on the prices of risk assets, and we don't really know how the crypto space is going to respond entirely, particularly because there's times when crypto is responds proportionally in price to gold. I've seen contrarian price action where we have increasing dollar price, DXY going up, and we have bullishness in the crypto space. So we have correlation and inverse correlation to both inflationary and deflationary pressures, which may indicate that it's not correlated to anything. There's an inverse correlation to everything, and it operates unto itself. So we only know how things are going to play out in hindsight after market events and market action takes place. A catastrophic recession implies maybe a deflationary event, or a liquidity crisis where um, the broad equities markets depreciate significantly and we have like a massive 15, 20, 30, 40, 50% retrace. But we live in a world where the central banks are interventionistas. These boys intervene in everything, and they're going to want a standing repo facility, either for repos or reverse repos. They just want to control the entire, uh, uh, you know, treasuries and bond market, which is basically the entire collateral market. Right now, we have reverse repos going on in the banking system where the banks have the excess reserves and they want collateral, pristine collateral. They want treasuries. There isn't enough treasuries. And basically, the repo spike in September 2019 was when there was not enough dollars and there was too much pristine collateral. And that's the way. And the only way the Fed's going to be able to control this is with a standing repo facility. Um, Once they intervene, now they're the last line of lending and borrowing, the last line of defense. And if they don't provide that intervention, the system is going to become unstable. It's become so exacerbated with how far the broad equities markets have inflated in price that if they don't continue to be the last lender and borrower, the system is going to experience a very catastrophic deflationary event. But bear in mind, it's not as simple as that, particularly because if there's a catastrophic deflation in the broad equities market, that's basically a liquidation process where assets are sold for cash, and to prevent capital destruction. But now we have all those people liquidating for cash. What the heck are they going to do with the cash? You can't keep cash. There's a 22% carry cost with the debasement calculation that they've done. So if you hold cash for 1 year, you're losing 22% of your money. So we live in a world where holding cash in a bank account is a fiduciary responsibility. You got to deploy that cash as fast as possible into some sort of asset to prevent capital destruction. So now we come to what kind of asset? And the only appropriate course of action, in my mind, is to hedge the hedges of the hedges. I bought treasuries yesterday. I bought a 10-year and 3 month. Not a large amount, probably about 8% of my traditional finance portfolio, but it was a capital deployment as a hedge to have deflation protection. In the case of a deflationary event, capital historically floods into bonds and short-term treasuries, T-bills. And in that instance, yields turn negative and the bonds go straight up vertical. Now, bear in mind, we live in a world where the Fed is interventionistas. They probably don't want rates to go negative. So maybe they'll counter the negative pressure and sell, or maybe they'll create it. And then that'll further exacerbate inflation if they're creating additional treasuries and selling them into the system. That's increasing the supply of collateral that's in the system, and that further destabilizes the system. But they'll have to sell treasuries in order to prevent the buying of treasuries in a deflationary event from driving yields negative. Fascinating stuff. Fascinating stuff. That was the first question of the day. So let's keep it going. Warren, looking forward to today's topic. It's not. It's more of Q&A, and your guys' thoughts and questions drive what I talk about, and that's the way I love it. I love Q&A. Happy July 1st, people. Ding ding in the house. My strategy of the month: lay down flat and wait for all my coin babies coming out of the end of the month. Well, we got yield in the crypto space. We have yield that doesn't exist in legacy finance. We have cash flow machines. We have revenue streams. We have monetary velocity, the lending and borrowing of capital. We have collateralization of historically uh, illiquid assets, or no, not illiquid, but we have collateralization of historic stagnant equity that's occurring in the DeFi space since March of 2020, which is downright fascinating. So we have novel uh, processes going on in DeFi that didn't exist historically, and this is all brand new within the last 2 years. So everything is different. Everything is very different with the congressional hearings that we had yesterday. They have no idea what they're talking about. They have no experience. They're completely out of touch with the reality of the general public. They're even further out of touch with the reality of the crypto space. They just don't have experience with it. They have these very broad, high-level thoughts that are coming from, a very deprecated, antiquated perspective. Um, but you can only understand really what's going on in the crypto space if you're in it, operating within it, engaging with it, or capitalizing on opportunities. Um, so they're just so far departed from reality. It's fascinating watching them ask questions. Tom Emmer actually is extraordinarily in touch. So there's very much politicians that are worthwhile to point out that truly get it. Tom Emmer truly, truly gets it. And that's actually one of the very few politicians that refreshing to hear and watch articulate the way he sees the space and its value and its purpose and its meaning. He believes it's fully regulated in its current form, and I agree. Oh man, he's great to watch. So thank you, Tom Emmer. E. Carlson, welcome. George, Baby Boom. Warren, oh no, I missed the ladies and gentlemen of the crypto space, but we'll have one tomorrow, so it's all good. Helder, morning, everyone. Ali in the house. Dominic, yesterday you said you lose 22% of your money keeping your money in a bank account. Can you explain how the 22% is calculated? Yeah, so in 2020, the U.S. government increased circulating supply of currency at the M2 level about 22%. Uh, Partially by accounting changes, but generally speaking, historically it was about 15% debasement as calculated by the Chapwood Index. So if we extrapolate a little bit and we consider that they just printed treasuries, the Fed plus the Treasury bypassed the commercial banking system's money creation process for the first time in history. Yeah, I would say probably 15 to 22% per year of your dollars in a bank account is gone. How does that happen? The prices of goods and services go up on average about 15 to 22% a year. Now, all I know is I got a haircut in before the pandemic at $20, and now it's $30. So it now costs me 50% more money to get a haircut. Now, Stephen Van Meter talks very well about the concept of the general public rejecting the increase in prices, the inflation of prices of goods and services. Now, it's a very dynamic system. There's nothing that's cut and dry. And I like that idea that we will have widespread rejection of cost increases. But we also know that the wealthy don't give a shit. So there's a large percentage of the population that are more wealthy than ever. They will never reject any price increase because they don't care. They don't care if a haircut costs $50 because they're making $10,000 a day in revenue. It means nothing to them. So I think that we'll have a large amount of price rejection or inflated price being rejected, but that'll overwhelmingly be compensated by the wealthy who don't care about the inflation, and it basically means nothing to them. It's all speculative, and that's why I say we only know in hindsight how these markets will play out, because it's such a dynamic and well, the dynamic interaction of loosely coupled phenomena that manifest the trajectory of the market actually playing out. Something like that. That's a lot of fancy words, but shit, it's complicated. Whoa, I got a lot of comments to go through. Let's keep it going. Oh my goodness. I'm missing a lot. Dominic, M2 divided by CPI index. That's a nice observation right there. Wave, yo. Dominic, Yellow Mellow. When you paid your crypto taxes, did you consider using, for example, Aave loan to pay some taxes to avoid subsequent tax events? That's not a bad idea, particularly because I paid taxes for last year and I experienced a taxable event paying taxes, of which right now I'm accumulating my tax obligation for 2022 that I have to pay for 2021 merely because I paid taxes in 20 for 2020. It's kind of shitty. So they're taxing the taxes of the taxes, these fuckers. Alex, I'm getting to watch this off grid with Starlink Sat Internet. That's awesome. Good for you. Enjoy and keep us posted. That's awesome. Derlin, regarding U.S. taxes, there are specific points at which you enter your interest from. Well, I operate like a business, and I treat capital gains as business income. So I paid short-term capital gains tax. I'm not going for long-term capital gains tax treatment. And I extract money to a bank account, which is a salary, and I have to pay taxes on that salary. So I keep an account aside that accounts for any realized gains that I take as income. And that's my tax obligation. I treat this as a business. I take a salary. I pay taxes on the salary that I take. Basically, anything that I pay or use or consume is a salary, and that's what I'm paying taxes on. Um, Alex Moore, every time you claim it's taxed as income and selling would be under cap, some shit like that. Basically, the tax regime is extremely complicated, and you could go through token tax and follow the super duper uh, interpretation of or speculation in many regards of the interpretation, because that's all we have is FAQs. That's what we have for crypto taxes is FAQs and trying to apply traditional securities and capital gains rules and regulations to the crypto space. So it's quite misleading because a lot of the operation in the crypto space really falls under business operations. And that's a valid way to interpret income and expenses and salary. So, and they're debating in Congress yesterday that some of the crypto space falls under securities, some of it falls under commodities, and clearly, they didn't even touch on whatsoever banking because Aave is a money market and that provides collateralization, lending, and borrowing services. So, where the hell does that fall? That falls under banking regulation, no doubt. But interacting with those services, how does it fall under SEC or CFTC guidelines? That's more of like SBA. That's more like business. So they have no idea what they're talking about. Everything that's going on in DeFi is surely not cut and dry, surely gray across the board and open to significant interpretation. You're 100% sure ICE will share fees with staked ICE. FM, I have no idea what developers are going to do. They're going to do what they're going to do. And all I know is, unless I could say, if I deploy X amount of capital and get X amount of revenue per day, then I don't know what the heck I'm doing, so I'm not going to do it. Uh, I'm 0% sure ICE will share fees with staked ICE. If you want more information, you could follow them on their Discord channel. And I avoid speculation at all costs. I am not a speculator at all. I cannot really understand what makes curve and convex deflationary. Can someone explain to me? So curve on a daily basis is emitting curve that incentivizes LP participation. And that curve that's emitted is being locked for VE curve, YVE curve, and CVX CRV. And now really has become significantly deflationary because of the Badger derivatives of convex pools or convex CVX CRV positions. So more CRV is being locked into VECRV, CVXCRV, and YVECRV than it is being emitted on a daily basis. So if a protocol, that makes it net deflationary. Every day there are less CRV in circulation. That's how it works. Adam Supno, a full intro. Any good websites, videos that you know can explain 22% inflation? Got a few friends I like to share with. Uh, Willy Woo. Follow Willy Woo on Twitter. He posted yesterday that mentioned the 22%. Here, I'll find it for you guys. I'm gonna have to jump on the stream. I got some work to do in a little bit. But let's check this out. I want to show you guys. You guys need to see it. If it ever loads, Willy Woo is a very broad thinking macroeconomist. He understands a lot of it. Yeah. So he says, congrats to the Fed, new high score. If you're not getting 22% ROI on your investments in 2021, you're going backwards. So that's it. Obviously, he's measuring M2 monetary inflation, and it's hotly debated that they changed the accounting standard for M2. And I'm not in a position to be able to argue for or against that. But what I do is understand that if they increase circulating supply of M2, which is basically like all deposits and all accounts and basically money that's either in a deposit or in some sort of fiat somewhere. If that enters the economy, as George Gammon said, is that a deposit in the real economy, that increases the amount of capital that's in the real economy. And that means you own 22% less of all cash outstanding on a yearly basis, at least for the last year, 2020, considering what they did. And we have to account for that in 2021. So there's Willy Woo talking about 22%. Hat are you using to earn revenue on Bitcoin? I don't earn revenue on Bitcoin. Currently, I have it in cold storage. It's not a highly functional asset. You cannot earn a meaningful amount of capital on Bitcoin unless you rehypothecate it. And I don't want to rehypothecate Bitcoin. Bitcoin is Bitcoin. Bitcoin yields 200% APR per year in appreciation, doing nothing with it. So that's more than enough for me with regard to Bitcoin. Dominic, are you using to remember Dominic, Sean, Mark? I don't know what you mean. George, probably a bit off topic, but do you think there's a chance we could ever have a token for our stake CVA that uses collateral on Aave? Maybe. Maybe, particularly because Aave does take Curve as collateral. So, I mean, it's up to Aave. So, Aave is a decentralized governance system. So, you can make a proposal for their governance, and that's okay. So, maybe one day. Mark, a pleasure also. Hello, Sir Noah. Pleasure, pleasure. Drizza, good morning. Adam, Astrologica, Noah will be able to explain better, but Curve is disinflation. So Curve's primary emissions are disinflationary, which basically means there's less and less emissions on a daily basis. Anyway, I'm going to have to wrap up the stream. I have to talk with some folks. So I appreciate everyone joining. Let me wrap it up. 12:05 p.m. Thursday, July 1st. And tell everyone to join. And I'm sorry I cut it short today, but I will see everyone tomorrow. Y'all have a good day now.